In this video, we are going to talk about choosing a source of credit. This is part one. Sources of consumer credit. So what kind of loan should you seek? Well, all loans are not equal. Some are cheaper than others. So let's start talking about the inexpensive loans. Yes, borrowing money from family members, friends are typically considered the most inexpensive because they hardly charge you interest. They'll let you borrow the money, you pay them later. And even if they do charge you interest, it would be typically a very low amount in comparison. So yes, friends and family are sources of funds when it comes to borrowing money. Loans that use your financial assets as collateral. So if you are able to put a property as collateral, it lowers the risk of the person lending you the money because they have a way to try to collect and get their money back. So they're willing to then charge you a lower interest rate. Medium price loans, commercial banks, savings and loans associations, and credit unions. So typically your financial institutions that are dedicated to this will charge you a little more interest than a family member. And if you don't use collateral, it will be a little higher. But however, that will be the next level of pricing. Now, when it comes to expensive loans, you have heard of those check cashing companies. Some of them let you write a post-dated check and they give you the money now. You wait until payday. Payday loans is a new common term used for those. Well, if you actually calculate the amount of money you're paying back, the interest rate will be very, very high, very high. Retailers such as car or appliance dealers, that may hold true. It just depends on the situation. Many car dealerships, the financing that they offer you at location may come from an outside source, which could be a regular bank or even the manufacturer of the car itself. So that financing could be regular, to put it that way, the medium price loans. But sometimes when they do in-house, in order to facilitate people that cannot get those loans, then yes, the interest rates can be very, very high. Same with appliance dealers. If it's coming from a different source, it might be a reasonable loan or credit that they give you. But when it's in-house, it's typically much, much higher. You just have to check what is that they're offering. Bank credit cards and cash advances. Generally speaking, credit cards always going to be in the higher end, mainly because it's revolving and no collateral. Typically, it's like a signature loan. They're just trusting your word that you're going to pay back. And you get to keep on borrowing according to your limit. It doesn't necessarily go down. It's an open account. Tax refund loans. These are very popular. People do their tax returns and the company, I'm not going to mention any company, not to target, because they all do the same. They say, hey, we can go ahead and give you the money now, and you don't have to wait for the IRS to give you your refund. But what they do is they charge a fee. And when you look at it from an interest rate comparison point of view, it's typically very, very high. So let's talk about the cost of credit and some of the laws that are out there to help you. Truth in Lending Law is a federal law that requires creditors to disclose an annual percentage rate. Now, this is what happens. There are many numbers that are presented and do this, do that. This is what it looks like. And they may arrange it in many different ways that makes it hard to compare loans on which one might be more beneficial. However, there's this thing called APR where everything gets placed in a certain way that cannot deviate or change in the way it's calculated, and to give you this one number. So the first place to start comparing loans and credit is that APR number. That will give you a good sense of how much that loan is really costing you. And the reason is because there's a combination of interest rate, fees, and other ways that you're paying for the loan that might be difficult to compare it by just looking at the numbers that may be laid out in different ways. But when you look at the APR, that's your starting point where you can tell, okay, this loan is more expensive than the other loan. The higher the APR, the more expensive the loan is. Some other things will come in play for the decision, and we'll talk about that a little further down the road, but that should be your first starting point to understand which loans are more expensive than others. There are situations where you may accept a little higher APR, but because you get a different benefit, like a longer term loan with lower monthly payments. But that's depends on your situation if one is better than the other. We'll talk about it a little more later. Finance charge is a total dollar amount you pay to use credit. It includes interest costs, service charges, credit-related insurance premiums, or appraisal fees. It just pretty much brings everything together. The annual percentage rate, some more on it, is the percentage cost of credit on a yearly basis. So annual of the APR. And it's pretty much reiterating what I was talking about. Your key to comparing costs, regardless of the amount of credit or how much time you have to repay it. And so it brings everything at an even playing field to compare. And that's what I mentioned earlier, that the APR doesn't necessarily show or is impacted. It's not necessarily impacted by how much time you have to repay it. And that's why I said that APR, you start there, but then look at the other features of the loans to see which one better suits you. APR is a true rate of interest, so you can compare rates with other sources of credit. It's a standard way of calculating it, so they cannot trick you. As long as they're reporting the APR accurately, they're not doing anything funny with the numbers, which will be legal. APR is a true comparison. Now, however, the law does not set interest rates or other credit charges. They just say they have to report it in a way where you can compare. A caveat on this, the law does not set interest rates. There is a thing called usury laws. It varies from state to state. And what they do is they have upper limits of how much interest can be charged depending on the transaction. Just to be, so you're aware that there are some laws in some states, the number varies between states, that does have some control over the interest rates, meaning a cap. They cannot charge more than at a certain point. And tackling the trade-offs. Term versus interest costs. This is what I was talking about earlier. So the longer loan, let's say you're borrowing the same amount of money and they have the same APR, but one you have to pay back in 15 years and the other one you can pay back in 30 years. So the longer loan, the one with 30 years, will give you a much lower monthly payment. So it's easier for you to make that payment. But because it takes longer, then yes, your total interest over time will be higher. But it did make your monthly payment easier. This is a common trade-off when you're buying a home. You hear a lot about 15-year mortgages because the interest you pay is total interest you pay is much lower. And you may also get a lower interest rate because it's a shorter term loan, meaning lower risk. However, your monthly payment is going to be much, much higher. What this translates to is that the purchase price of the home you can buy is going to be lower. You have to buy a smaller home or a lower priced home in order to make that monthly payment. But you do pay less interest. The trade-off is I do a 30-year mortgage. Yes, I'm going to pay a little more interest. Could be a lot more interest, it depends on the situation. But because it lowers your monthly payment, it allows you to buy a bigger home. So there's some trade-offs there, and that's what I was kind of talking about, that you not necessarily want the lowest APR depending on what your goal is. Also, you can always make additional payments monthly, voluntarily, and it could reduce up to the same amount like your interest cost. So lender risk versus interest rate, some ways to reduce the lender risk and your interest rate. You can accept a variable interest rate. This is true, but something to be very careful. What a variable interest rate means is that they'll start you off with a lower interest rate. They can do that in a variable situation because now the bank doesn't have the same risk as a fixed interest rate. And the reason why is because if interest rates go up in the future, they can then increase your interest rate. So their risk of changing interest rates is not there, so they get compensated. So they can start you with a lower one. With a fixed interest rate, they cannot do that, so they're taking risk. So they're going to charge you a little more. Now, the risk to you is if the interest rates start going up significantly higher, your monthly payment will go up significantly higher to the point where it may have very negative consequences. So it's something to really be careful with and understand how it works. Provide collateral to secure the loan. If you want to lower your interest rate, and the only way to do it is to reduce the risk of the lender, collateral, as we mentioned before. Make a large cash down payment up front. What that is doing is just really bringing down the amount you're borrowing to a lower number. So there's just another way to say that you're borrowing less money. The less money you borrow, the lower the risk for the lender. Accept a shorter term loan. This we're talking about a moment ago, 15 years versus 30 years. Yes, you get a lower interest rate, but your monthly payment is going to be significantly higher. Okay, the minimum monthly payment trap. This is more directed towards credit cards, is the most common example. And as you can see on the slide, minimum monthly payment is the smallest amount you can pay and remain in good standing, meaning that they don't report you to the credit bureaus for not making the payment. However, if you only make that minimum payment, your total interest over time always going to be in the higher end. So think about that a lot with credit cards. Now, it's good to have a low minimum monthly payment. So if you had a bad month, an emergency, then you know that, hey, I only have to put this little bit of money because I didn't have the cash that month, but don't make it a habit. And there's an example of the differences of making minimum monthly payments. So early repayment and credit insurance. The rule of 78 favors lenders. I'm not going to get too much. The rule of 78, just you divide a number with a rate, and it gives you how long it takes to double the money in the time wise. I'm sorry, that's rule 72. But the point is, what you really want to get out of this is that the longer you take to pay the loan, the more interest the lender's going to collect. So it's beneficial to them. Another thing to understand is that, as it says in the second bullet, if you look at amortization table, the way loans work is that your payments at the beginning of the loan mostly go to not mostly, but a big chunk goes to interest, and a smaller amount is going to go to the actual principal. As the principal gets worked down, the same payment you make gets split differently. A little more starts going towards principal and less goes towards interest. So the early payments a lot of interest is going in there. So that's beneficial for the bank. And then the later payments, it's mostly principal and little goes to interest. So what happens is when you start doing early repayments, you are shifting that timeline in your favor, because now that turning point, or the difference of interest and principal, how much is going to each one of them with your payment, starts shifting quicker. So the principal comes down quicker. So the interest you're paying on the principal is going to come down quicker. But that means you have to put money up front as you pay. So it's an alternative to down payment. Just make extra monthly payments and you will have an effect, that effect. Credit insurance ensures loan is paid off in the event of death, disability, or loss of property. Many loans out there, not all, but many loans out there will already have some kind of death or disability insurance built in the cost that they're charging you. And but it's loan specific and all that. Three types include, there are many more, and there are other versions, and the wording may change in the names, but include credit life, credit accident health, and credit property. Now, premiums are quite high compared to regular loans. But like I said, a lot of loans out there already have that built in. So when you look at your APR, it's already included there. If you were to get additional credit insurance on the side, then that's up to you. That's a question to ask as you're getting the loan. Especially if there are cosigners, it's important to understand this. Managing your debts. If you foresee an unexpected event coming where you may not be able to make a payment, your best bet is to first call them, let them know, and see if you can work something out. Now, the truth is they're going to, by all means, try to avoid making a payment plan with you. That's their business. I have even seen situations where they say, we do not do payment plans until after you miss a payment. So sometimes you actually have to miss a payment before they even want to listen to making a payment plan. Sometimes they're tough like that, but always try up front, because if you can manage some kind of workaround, it will prevent them from reporting you to the credit bureaus and affecting your credit long term. If automobiles are repossessed, or any other physical asset for that matter, the way the typical loan works is, and this is applies to houses that get auctioned off, but let's use the car as an example. If you owe $10,000 in the car and they have to take the car and sell it, and it sells for $12,000, then $10,000 goes to the car, and any other fee expenses for repossessing the car gets covered, and whatever's left over is yours. If it sells for less, technically speaking, you still owe that money, but how it gets reported is up to the lender, how that gets dealt with. Debt collection practices, fair debt collection practices. This is good to know, this information. If you find yourself in a situation where debt collectors are calling you and harassing you, not all debt collection attempts is harassment, but they sometimes get into the harassment stage. So it's good to know these things. So there is a Fair Debt Collection Practices Act where it said it's okay for them to collect, but they just can't go overboard. So if a debt collector calls you, that's typically the first step they do. They call you on the phone, letting you know. You want to ask them within 5 days, they must send you a written notice of amount owed, like a formal written notice. This is how much you owe. This is, the debt that we're trying to collect, like the details, the creditor's name, and your right to dispute the debt. You can always dispute a debt. It's common practice. Now, at that point, you can dispute it or pay it. is it depends how you feel about it, I guess, or what the current or the actual situation is. If you dispute the debt, then this is what it would look like. You may request verification of the debt within 30 days. So that initial letter is just information, but it's not the actual verification of the debt. They have to show paperwork, whatever you signed or whatever you agreed on, whatever you clicked on. There has to be the evidence that you actually took that debt. If they cannot provide that evidence, then you technically, that's not your debt, and you definitely want to dispute it. There have been some unique situations with mortgage homes where a lender does originate the mortgage and the person did buy the home and signed for the mortgage and everything. But then those mortgages sometimes get sold to other companies, bigger banks or something like that. And that paperwork gets lost sometimes. So there have been cases where they try to foreclose on a home because somebody didn't pay, and they go through this process. And because they can't find the original note of the mortgage, and the title is already it's already being shifted to the person, it becomes problematic for them to foreclose or collect. In some extreme circumstances, the person keeps the home and there's no debt until they can find that paperwork. So if they lose the paperwork, it could be very good for you. And it happens. It does happen. If verification is sent, you may pay the debt or give notice that you will not pay. So let's the verification is sent, and that's assuming it's legitimate, that there's a true debt that you own. Then it's up to you to pay or not pay. Now, if there's any issues with the verification, that's where you continue to dispute. We will stop this video here and we'll continue part 2 on the next video.